This is Terry and Sarah. Now, Terry and Sarah are a vibrant couple that live in Tennessee and are right on the cusp of retirement. They've accumulated a sizable nest egg and because of this have a strong retirement plan. But not everything is smooth sailing because they have a big tax issue coming down the road. If they stay on their current path, we estimate that Terry and Sarah are going to overpay Uncle Sam by over $275,000 in taxes. So how can they build a forward-looking tax plan to completely wipe out this tax bill? We're going to show you. So let's first start out by talking about some important details around Terry and Sarah's situation. Now, they have the lion's share of their retirement assets saved in tax-deferred accounts. They both had good paying jobs while they were working, and like many families, it was very difficult to pass up the tax benefits that they gained from contributing to their 401k. So now this ends up being their largest asset and can spell some problems down the road because at some point they're going to be forced to take from those accounts. Now, based on some underlying health conditions that Terry has, we've found that their optimal Social Security strategy is a split strategy, where Sarah delays her benefit until age 70, thus earning a larger benefit, and Terry takes his benefit at full retirement age. Now, Terry just turned 63 this year, and for planning purposes, we estimate his longevity to be in the early to mid 80s based on some underlying health conditions as well as some questionable family longevity. Sarah, on the other hand, is turning 64 this year and is in great health and has some great family longevity as well. Because of this, we estimate her longevity out into the mid 90s. Now, they ultimately want to spend about $75,000 per year, and that's net of taxes. For the first 12 years, they want to spend an additional $12,000 on top of that for travel goals. Now, you'll note that when we build an income goal, we're always looking at these net of taxes and healthcare. The reason being is because taxes and healthcare are changing expenses that we want to make sure we estimate separately. Finally, and sometimes most importantly, the main focus of their plan is first, safe income for their situation, and second, legacy. And so this is very important and can often change a retirement plan altogether. Ultimately, if their assets keep growing through retirement, they want to leave a considerable amount to their children as well as grandchildren. And so tax-efficient estate planning will also be a focus here that we'll need to touch on. And so let's start talking through what their current tax plan looks like. Now, just as an aside, if you like this video and like the case study style of this video, please let us know in the comments below, and we'll try to record more videos just like this, walking through different case studies that can benefit your retirement. Now, when we first met Terry and Sarah, both were planning on working an additional 2 years. Terry loves his job, and they were both a little bit hesitant about navigating pre-Medicare healthcare. The problem here is while they were both working, they earned enough income that they had a sizable taxable income that really didn't leave much room for tax mitigation strategies. Because of this, this would mean that their tax-deferred accounts would grow additional years, really unencumbered, and would grow that much larger down the road, leading to additional tax problems. Now, despite this, Terry really wasn't ready to stop working. He was currently in the midst of a project at work that he really wanted to see through. Sarah, on the other hand, was a completely different story. Their daughter had just had their third grandchild, and Sarah was longing to be a little bit more of a full-time grandmother rather than a full-time worker. Now, with this in mind, we found a middle ground that is seemingly small but will have a massive impact later on in their retirement. We found a split strategy where Terry continues to work an additional 2 years while Sarah immediately retires to be their optimal path. From an income standpoint, they put no more stress on their plan because while Terry is still working, they will have his income that's filling their income need as well as having insurance covered. With Sarah retiring, however, we eliminate her income from their taxable income, leaving additional room for tax planning. This seemingly small change is especially important in today's tax climate because right now we're underneath the Tax Cuts and Jobs Act, which means a higher standard deduction and lower taxes across the board. But we know this is set to expire in 2026. And so Sarah retiring early gives us an added advantage to use this Tax Cuts and Jobs Act. Now, based on the goals that Terry and Sarah have, they have a very strong retirement plan. Out of the 1,000 simulations that we ran their plan under, only 20 of those simulations ended up failing. And so this is really an optimization plan, all things considered. Now, many retirees will simply stop here. I have a good probability of success, so what else is there? Well, unfortunately, they have some tax problems that will only be realized once it's already too late. And so before going into some of the tax mitigation strategies, let's talk about what those problems are. First, here is their estimated tax plan in Trial 500, the median trial. Now, in practice, we would look at multiple trials in multiple simulation periods in order to gain a better understanding of what their tax strategy should look like moving forward. But for the sake of time, we're just going to focus on Trial 500 here. Now, we can see right off the bat that required minimum distributions that they're forced to take from their tax-deferred accounts at age 72 immediately become a tax problem. Now, note that these will be paid under the Post-Tax Cuts and Jobs Act rates, which will be higher rates. But we see that these RMDs force them to scale additional brackets. They move from the 25% bracket up into the 28% and even up into the 32% bracket. And so we know that we can convert today in order to avoid some of those RMD problems purely from a tax rate standpoint. But ultimately, to plan properly, we need to understand all of the tax problems that are hidden underneath the surface that are created directly or indirectly from these required minimum distributions. The first is related to Social Security. Now, once Terry and Sarah are on Social Security, RMDs, even small RMDs, can really create a tax problem because they create a double taxation zone. Because the amount of your Social Security benefit that is ultimately taxed is determined by how much other taxable income you have. So here's how the math works out. Based on how much they have in Social Security benefits, for every dollar that they generate from RMDs, it will force 85 cents of their Social Security benefit into being taxed. So because of this, the marginal tax rate on that dollar rises by 85%. And completely changes the tax graphs that they ultimately need to plan under. No longer is the 15% bracket 15%. It now scales all the way up to 27.75%. This is because of that 85% marginal increase in their tax bracket. On top of this, they will see themselves move through the tax brackets that much faster because a dollar of RMDs forces a $1.85 to be added to their taxable income. And so they'll move through the 10%, 15%, and 25% brackets that much quicker. And so we see that this tax trap will spike their marginal rate and make it that much more costly to receive those excess RMDs that they ultimately don't need. The next hurdle they need to be considering is IRMA. So if they show too much income, they will see an increase in their Medicare Part B as well as Part D premiums. Now, IRMA is somewhat complex because it's a 2-year look back and it's based off your modified adjusted gross income, not your taxable income. And so for visualization purposes, here's where these IRMA brackets ultimately fall in terms of the married filing jointly brackets. Now, the problem here is RMDs are forced income and they generally increase over time. And so when someone is subject to IRMA when RMDs begin, they will likely see IRMA expenses added on an ongoing basis because of these required minimum distributions. And if we calculate out the added tax rate from taking these given IRMA charges, it translates to 3 to 5% in added taxes within those given IRMA zones. In addition to this, RMDs can also make some of your other accounts less valuable. Let's take something like their taxable account. Well, for various reasons, this taxable account can generate long-term capital gains. It's very important to understand how your income stacks in the eyes of the IRS. Now we'll notice on the screen that long-term capital gains stack on last. They stack on after you've already taken your required minimum distributions. Now in a perfect world, if this couple didn't have any RMDs and they just had Social Security income and Roth withdrawals, they would be in the 0% long-term capital gains bracket. But because of these RMDs, those RMDs are pushing their long-term capital gains high enough that they'll be taxed at 18.8%. Now, how is this possible? Well, current RMDs push them well into that 15% zone, but there's an added tax zone that needs to be calculated out here as well due to the net investment income tax. Once this couple shows over $250,000 of adjusted gross income, they will be subject to the net investment income tax. This is an added 3.8% tax on long-term capital gains. Note this $250,000 limit is not inflation adjusted, and so once again we see RMDs have an added indirect cost. The final trap worth noting here is something called the widow trap. Now this is especially important in Terry and Sarah's situation because of Terry's underlying health conditions. Now when Terry passes away, Sarah will inherit his tax-deferred accounts and will have very similar required minimum distributions because of this. But now she goes from the married filing jointly brackets to the single filer brackets. So the income that she has will scale those given brackets that much quicker. Not to mention, Sarah will have half as much room in these IRMA brackets as well. Now, a critical takeaway for Terry and Sarah, as well for you, is that you cannot procrastinate on these RMD problems. Once RMDs start, the options really start to dry up. Now, with a forward-looking tax plan, you have to be able to answer 3 critical questions. The first is, what tax mitigation strategies are available to my plan? The second question is, what rate am I paying today with these tax mitigation strategies versus what rate am I avoiding down the road? Finally, are there future opportunities to implement some of these strategies at a better rate? For instance, if we're converting at 24% this year, that might make sense in the grand scheme of things, but if we can convert later on and accomplish the same goal at 12%, that makes a lot more sense. Now, Roth conversions will be the single most important strategy that this couple implements. And if we look at their tax graphs, we can see why it's especially important to be converting underneath the Tax Cuts and Jobs Act. If we look at the rates that they can pay today at 22% and 24%, if we just look from a pure tax standpoint at what they're avoiding in the future, if they're being taxed at the 22% bracket or anything higher, we are seeing a benefit. And the reason being is because after 2026, these brackets are reverting back where the 22% bracket becomes 25%. Converting that 22 and 24 today to avoid 25% makes sense. But we can't just compare tax rate to tax rate. We have that pesky thing called IRMA. And remember that IRMA is a 2-year look back. So not only do we need to be thinking about IRMA down the road, but we need to be thinking about IRMA right now. IRMA is a tax cliff. So we want to use all of the space that we have in any given zone, because if we show $1 more, we are going to have that Medicare penalty. Now, because of this, doing something like maxing out the 24% bracket doesn't really make any sense because we're not fully using that tax zone. We also don't mind converting when one person has filed for Social Security, but we generally want to avoid converting when both have filed for Social Security. The reason being is because a Roth conversion will essentially push us into that Social Security tax torpedo that we're ultimately trying to avoid down the road. Finally, we don't want to convert all of their tax-deferred assets because we can later fill up lower brackets like the standard deduction and 10% bracket with smaller RMDs later into retirement. So here's what an optimized tax mitigation strategy looks like for their situation. We are converting into the 24% bracket for a few years underneath the Tax Cuts and Jobs Act. From there, we're paring back our conversion strategy and really only converting into the 25% bracket. We don't want to go higher than that because then we start to move into that 28% bracket, again, post Tax Cuts and Jobs Act rates. Now, we're going to be taking a few IRMA penalties, but when we're taking those IRMA penalties, we want to make sure we fully maximize that zone where we're taking that given penalty. This leads to us not fully maxing the 24% bracket and also not fully maxing the 25% bracket as we're past those Tax Cuts and Jobs Act. Now, to maximize these tax strategies, we really want to be leaning on that taxable account. Now, they are currently in a situation where they have a very high cost basis ratio within that taxable account. They don't have a ton of unrealized gains. And so because of this, we optimally want to subsidize our income in order to leave more Roth conversion room, as well as pay Roth conversion taxes out of that taxable account. This will ultimately lead to more money within their Roth IRA, and it will drain their tax deferred as well as taxable account. Now, a very important thing to note here, as you see the over $275,000 that this couple will save on their tax bill, is that this plan is not chiseled into stone. It needs to be dynamic along with most things within your retirement plan. Keep in mind here that a lot of factors can change. The further out that we estimate Roth conversions, the more likely it will need to dynamically change. Think about things like tax changes that Congress might implement, or think about how investment returns may increase or decrease the overall tax deferred balance that they ultimately have, leading to larger or smaller Roth conversions into the future. A forward-looking tax plan is not a one-time event. It is one that needs to be updated on an annual basis. It's also worth noting that they're not only saving on taxes during their lifetime. Remember that they have that legacy goal. And so as they're passing on money to the next generation, what type of account they pass on will have completely different tax considerations. As you see on the screen here, when we implement those Roth conversion strategies and estimate the growth within each of their accounts over the long term, the account that they pass on is primarily a Roth account, which means that it will be tax-free to the next generation. Thus, the next generation will save greatly on taxes as well. Now, this couple's situation was a little bit simpler in terms of where to pay Roth conversion taxes out of because of that high cost basis ratio within their taxable account. But let's say that they had large unrealized gains within that taxable account. Well, now the math might change. Well, how do we know what is the best place to pay those Roth conversion taxes from? Here's a video right here that walks through the exact breakdown for when it makes sense to pay out of your taxable account versus your Roth conversion. Now, be warned, this video is fairly math heavy, but is a powerful one for tax-minded retirees. Always remember, you don't need more money, you need a better plan. Thanks for watching.